Hello everyone and welcome back to the sessions on strategic financial management. Friends, in this class of CA Final SFM, we will begin with an important topic titled as share valuation. Let me remind you, you have already learned the portfolio topic. Lot of concepts of share valuation we have discussed along with portfolio. However, we will be discussing this topic from the scratch, from the beginning, so that you should find yourself comfortable with what concepts are being discussed over here. So most important thing, share valuation, this topic what we are going to learn is going to become the base for learning topics like corporate valuation, learning topics like mergers and acquisitions. Without proper knowledge of share valuation, it will be no point in getting started with topics like corporate valuation, topics like mergers and acquisitions, and even topics like FDI, that is foreign direct investment. So friends, when it comes to share valuation, there may be different bases of share valuation. So let us do one thing, let us identify different bases of valuation and then discuss one by one each one of them. So do one thing, pay attention on the screen and I first of all show you different bases of valuation. So first of all, let us talk about different bases of valuation. The first one would be asset based valuation, second would be earnings based valuation, third would be dividend based valuation, fourth would be valuation through CAPM, that is capital asset pricing model, and this type of valuation we generally term as equilibrium pricing. Fifth one could be PE multiplier based valuation, PE standing for price earning ratio. So PE multiplier based valuation, also known as contemporary valuation. So do one thing friends, write up this quickly and then I take you ahead. Alright friends, you would have finished writing this much. Let us move ahead and now talk about asset based valuation, the first valuation base. Now this is something very simple. When we say asset based valuation, your focus is on the balance sheet of the entity. So what you would do is, you consider all the assets of the entity. So you take the book value of all the assets. From that you subtract all the liabilities, all external liabilities. So what will happen? Asset minus liabilities at their respective book values will give you net assets at book value. Now the net assets will obviously belong to the shareholders of the entity. Now if the balance sheet indicates any preference capital, subtract the preference capital out of the total net assets. that is the net asset available to shareholders. From that you subtract the preference share capital, and if there is any outstanding preference dividend, subtract that as well. So whatever you have to give to preference shareholders, you subtract. Whatever remains will be the net asset belonging to the equity shareholders. That net asset, when you divide by number of equity shares, you will be getting the net assets in terms of per equity share, more technically known as book value per share. Friends, one more thing I would say, the asset based valuation could be little altered, could be little modified by replacing the book values of assets and liabilities by the realizable value of assets, and with respect to liabilities, the amount that is expected to be paid. That means we are using realizable values in place of book values. The result over there will then not be called as a book value per share, it will be identified as intrinsic value per share. So do one thing, friends, pay attention on the screen, and I'll give you the complete guideline of how to determine the value of the share using asset based valuation. So under this category, asset based valuation, if you are willing to determine the book value per share, see how it will be presented. Book value of assets will be considered. From that you would subtract the book value of liabilities, and what you get is the net assets at book value. Once you get net assets at book value, from that you subtract the net assets belonging to preference shareholders. You subtract that, and whatever you get is net assets belonging to equity shareholders. And once you get the net assets belonging to equity shareholders divided by number of equity shares to arrive at book value per share. And once you write down this much, I will show some important notes ahead. But first quickly write down this. Alright friends, after writing up this, let us move ahead and write up an important note. And I have already explained you one thing, that is, instead of book value of assets and liabilities, if realizable value of assets and amount expected to be paid towards external liabilities are considered, then the resulting value per share will not be book value per share, but it will be intrinsic value per share. Please note down this and then we move ahead. Alright friends, after writing this note about book value per share and intrinsic value per share, let us move ahead and now talk about earnings based valuation. Now a very simple notation, this thing what you would have learnt even at intermediate level, P0 equals to E1 upon KE, where P0 stands for the present value of equity shares, E1 stands for expected EPS by end of the year, and KE stands for expected rate of return by equity shareholder. Friends, do one thing, write up this and then I would explain you. Let us try to understand this calculation of P0. P0 standing for the present value of the share. Now friends, what happens? Just take a simple example. Assume that the expected rate of return of the shareholder is 25% and the expected EPS is rupees 40. That means by end of the year you are expecting earnings per share of rupees 40, and you being a shareholder, your expected rate of return is 25%. We are simply going to capitalize the earnings. So if earnings per share that is expected to be rupees 40, that is 25% return. So what would be 100%? So what is the capitalized value of your earnings? So simply divide 40 by 25%. The result will be rupees 160. So that result 160 indicates P0, that is the present value of the share. So when you talk about earnings based valuation, you are not looking into how much dividend is distributed by the company. You are just looking at the earning potential of the company. This could be a fantastic basis for determining value of the share when the company does not distribute any dividend. That means companies that do not distribute dividend obviously cannot follow dividend based valuation. For them, this earning based valuation would be most suited. So friends, when we talk about earnings based valuation, we have a little variation in this. We follow up a calculation known as return on capital employed based valuation. Now, return on capital employed, you know what is rate of return on capital employed? It is operating profit divided by total capital employed. And in finance, when we say total capital employed, we mean debt plus equity. So if you find out the total value of capital employed and from that you subtract the amount of debt, the remaining amount what you have in hand will be the value of equity. Likewise also, through return on capital employed, we can find out what could be the value of equity. So keep paying attention on the screen. I will show you even that other basis of valuation. Let us now talk about ROCE based valuation. ROCE standing for return on capital employed. And let us try to understand through an example. Say X Limited has 1 lakh equity shares of rupees 10 each, and the company also uses debt of rupees 20 lakhs as part of its capital. The return on capital employed for the company is 25%. X Limited has reported operating income of rupees 25 lakhs. Determine the value of equity share using ROCE based valuation. Friends, before I give you answer of this question, first note down this example in your notebooks quickly. Alright, after writing this example, let us look into how to write up the answer for the same. So, you begin with the information about operating income, that is given as rupees 25 lakhs. Return on capital employed is reported as 25%. Now, what we would say is, when you say capital employed and return on capital employed, basically this is indication of your operating income that you are generating on your total capital employed. If your operating income generating capacity is 25% of your capital employed and that operating income is 25 lakhs, we would say 25 lakhs represents 25%. So what will be the total value of capital employed? It will be 25 lakhs divided by 25%. That would give you rupees 1 crore as the total value of capital employed. From this total value of capital employed, subtract the amount of debt, and what you get is the total value of equity. That total value of equity comes to rupees 80 lakhs. Now, the total number of shares are 1 lakh shares, and therefore value of each share will be rupees 80. So friends, quickly take note of this as well, and then we move ahead. Alright friends, after writing up all this, let us move ahead and now deal with dividend based valuation. And in that category, we first begin with the base model for share valuation, and that is known as P0 equals to D1 plus P1 upon 1 plus K. And I'm sure what you find over here on screen is nothing new for you. But in CA Intermediate or CMA Intermediate, if you haven't learned this base model with simple logics, it's time for you to understand it now. P0 obviously indicates the present value of the share, that is the current value of the share. Now, D1 is the expected dividend that you would receive by end of the period. P1 is the expected share price by end of the period. So D1 and P1 will be basically the values in future, and these future values we are now discounting to present value by using our expected rate of return. So how do you generally arrive at present value? Simple logic is future cash flow is divided by 1 plus expected rate of return, correct? So what is future cash flow over here? Assume that the time horizon for investment is just 1 year. So what will happen? D1 and P1 will be the two components of cash flows that the investor is expecting to receive by end of the year. Why? Because D1 will definitely be a cash inflow. Expected dividend will be received in cash. If your investment time horizon is just 1 year, maybe by end of the year you sell out the share and you will get the price of the share in hand in the form of cash. So D1 and P1 will both be future cash flow after 1 year. You want to find the present value. So obviously the future cash flow will be divided by 1 plus expected rate of return, and the expected rate of return for the shareholder is what we define as KE. KE, from one side it is cost of equity for the company, but from the viewpoint of the investor it is investor's expected rate of return. So D1 plus P1 future cash flow divided by 1 plus KE, then 1 plus KE indicates the factor for computing the present value. So 1 plus KE is the factor. When you divide D1 plus P1 by 1 plus KE, you arrive at the present value of the share. So do one thing, keep paying attention on the screen and I show you something more in this category. So we have just identified that D1 and P1 are considered as future cash flows. KE is the expected rate of return, and P0, what you can see, is the present value of these future cash flows, and this P0 would indicate the present value of the share. Friends, before I take you any further, please quickly note down what you find on screen. Alright friends, after writing up this, I would want you to even write up the definition of all these variables, where D1 equals to expected dividend receivable by year end, P1 will be the expected market price of equity share by year end, KE is the expected rate of return by equity shareholder, also known as equity capitalization rate or cost of equity for the company. And P0, what you have found at the end, is the current market price of equity share. So note down the meaning of these variables and then we move ahead. Alright, you would have finished writing all this. Let us move ahead, and now we rewrite the same formula P0 equals to D1 plus P1 upon 1 plus KE. By cross multiplication, what you would get is 1 plus KE equals to D1 plus P1 upon P0. Now, the value of KE would be obtained by subtracting 1 from the entire term in the right hand side. So D1 plus P1 upon P0, from that if you subtract 1, you will be getting the value of KE. If I further modify this formula, if I would want to put this minus 1 within brackets over here, it could be not simply placed as minus 1, it would be minus P0 upon P0, because over here the denominator is P0. As a result, KE will be D1 plus P1 minus P0 divided by P0. Now we know one more thing, that P1 minus P0 divided by P0 indicates growth rate. That means this part of the formula, P1 minus P0 divided by P0 indicates growth rate, and this other part of the formula, that is D1 by P0. So finally what we can do is KE equals to D1 by P0 plus G, where G stands for growth rate. So friends, KE equals to D1 by P0 plus G. You have learnt this at intermediate level already in the name of cost of equity. This is dividend price plus growth approach for determining cost of equity. You need not write all these derivations because this is already given in your textbook, not only in share valuation topic but even in the portfolio topic. You have been given this whole thing. So let us move ahead, and now we would say if KE equals to D1 by P0 plus G, KE minus G, that means what we have done, this plus G from right hand side we have shifted to left hand side, it becomes KE minus G, and in the right hand side what remains is D1 by P0. Through this you can determine the value of P0, that will be D1 upon KE minus G. So P0 goes to left hand side and KE minus G comes to right hand side and becomes the denominator. So P0 will be D1 upon KE minus G, and this is nothing but Gordon's model. So one of the very popular share valuation model developed by Gordon is simply P0 equals to D1 upon KE minus G. So there is no need to write even what you find on screen now. So instead of this, you would better write up the Gordon's model as a proper heading and the Gordon's model formula for share valuation. P0 equals to D1 upon KE minus G. Defining all the variables, D1 is expected dividend receivable by year end. KE is equity capitalization rate. P0 is current market price of equity share, and G stands for growth rate. Nothing of this is new for you. Let us move ahead. Within Gordon's model, G equals to B into R. G stands for growth rate and G is equal to B into R. B stands for retention ratio and R is the return on equity. And what is retention ratio? It is 1 minus dividend payout ratio. So friends, in the earlier part you have observed everything was known. Now one new point that you come across which you would not have learned earlier was that growth rate is the product of B into R. B standing for retention ratio and R standing for return on equity. And through this, when you compute KE equals to D1 by P0 plus G, D1 by P0 would be identified as a dividend yield rate and G stands for growth rate. So whatever be the expected rate of return by the shareholder, it is basically aggregate of dividend yield rate and growth rate. So you could conclude that the expected rate of return by the equity shareholder is the aggregate of these two components, that is dividend yield rate and growth rate. So friends, do one thing, write up these important points quickly and then we move ahead. Alright friends, so you would have finished writing this much. Let us now talk about the assumptions under Gordon's model. So whatever you have seen over here, Gordon's model, it is backed by certain assumptions. That means without the backing of those assumptions, this model is not going to work. Assumption number 1, that the expected rate of return for the shareholders, what you symbolize as KE, is always going to be greater than the growth rate. That means KE will be greater than G. So cost of equity or the expected rate of return for the shareholder is always going to be greater than growth rate. Why like that? Look into screen what you see. KE itself is aggregate of two components, right? That is what? The dividend yield rate and growth rate. So to growth rate, when you add dividend yield rate, then you arrive at KE. So obviously KE is going to be greater than growth rate. Friends, in the Gordon's model, the base model formula, that is the Gordon's model formula, P0 equals to D1 upon KE minus G. Just imagine, if KE and G are same, what will happen? The denominator will become 0. You will not be able to determine the value of the share. If KE is less than the growth rate, what will happen? The whole calculation will become negative. That means to have some value of the share, KE has to be greater than the growth rate. That is the first assumption under Gordon's model. Second assumption under Gordon's model, companies must distribute dividend every year. Imagine if the companies are not distributing dividend at all, what would happen to the value of the share? P0 is D1 upon KE minus G. If D1 becomes 0, the entire value of the share becomes 0. That means Gordon's model cannot be applied if the company does not distribute dividends at all. That is why one of the assumptions in Gordon's model is that companies must distribute dividend. Third assumption in Gordon's model, that the dividends grow at a constant rate and that growth rate in dividend is same as the growth rate in share price. So understand this third assumption very well. First of all, dividend grows at a constant rate. That means dividend does not remain constant. Dividend grows at a constant rate and the growth in dividend is at the same rate as is the growth in the share price. Now, if the dividends are growing at a varying rate and not a constant rate, Gordon's model modification under a category of supernormal growth concept, we are going to extend that model and we are going to learn that concept of supernormal growth ahead. But as of now, what you find on screen, P0 equals to D1 upon KE minus G. To make this formula work, the growth rate has to be constant and the growth in dividend must match with the growth in share price. Fourth and last assumption, company must retain a portion of its earnings. If there is no retention, there won't be any growth. Why? Look into again what is written over here. Growth is a product of two components, right? Growth is a product of two components. One is R and one is B. R stands for return on equity. B is the retention ratio. So if there is no retained earnings, what will happen? There will be zero growth. Just imagine if the company distributes entire earnings by way of dividend, what will happen? In the hands of equity shareholders, whatever money goes is the entire earnings of the company. That means company has not retained anything with itself. If the company does not retain anything, the retention ratio will be zero. If retention ratio is zero, whatever be the rate of return on equity, that is ROE, return on equity, whatever it is, 0 multiplied to that, the whole growth rate will become 0. That is why to have some growth rate, it is important that company must retain a portion of its earnings. In simple words, if you want to systematically apply Gordon's model, the right situation is where the company distributes dividend and the company does not distribute entire dividend, company definitely should retain some portion of the earnings as retained earnings. So friends, let us do one thing. Pay attention on the screen and I show you these assumptions. You need not write up these assumptions because these assumptions are given in your textbook, but definitely when I am talking about these assumptions, you should be very clearly aware of these 4 assumptions which are at the backing of Gordon's model. So we are talking about assumptions under Gordon's model. First assumption, the expected rate of return by the shareholder KE will always be higher than the growth rate, that is G. Second assumption, the company distributes dividend every year. Gordon's model will not work for the companies that do not distribute dividends. The dividend grows every year at a constant rate. Such growth rate is same as the growth in the price of the share. Fourth and last assumption, the company must retain a portion of its earnings for the purpose of growth. Friends, I told you very well, you need not write these assumptions. These assumptions are given in your textbook already. So let us do one thing. Let us move ahead and start solving questions. So question number 1 to begin with. What is given over here? Expected dividend by the year end rupees 15. Expected market price per share by year end is rupees 155. Expected rate of return by the shareholder is 25%. Determine the current market price of equity share. Friends, now this is simple information which can be fit into the base valuation model, correct? That is P0 equals to D1 plus P1 upon 1 plus KE. So P0 is what you have to find out. You look into what is given. This expected dividend is D1, expected share price is P1. So D1 plus P1 divided by 1 plus KE would give you the value of the share. So let us see how to present the solution. You would first write P0 equals to D1 plus P1 upon 1 plus KE, and you would obviously define all the variables. D1 is the expected dividend by year end. P1 is the expected market price of the equity share by year end. KE is the expected rate of return by the equity shareholder, also known as equity capitalization rate or cost of equity for the company. P0 is the current market price of the equity share that you would want to find out. Friends, one thing I should tell you, every time you solve a question, you must write up the definition of these variables. If you don't do that, you will not be able to score marks. So if you just write the formula of Gordon's model and put the values and make the calculation, it's not going to work. You should define these variables. Further, when you solve this, it will be 15 plus 155 divided by 1 plus 0.25. And when you make this calculation, you will be able to get the value of the share. But before I do that, quickly note down whatever you find on screen. Alright friends, after writing up this much, do one thing. You would make the further calculation. P0 will be 170 divided by 1.25 and that will be rupees 136. So write down this also and then we move ahead. Alright friends, after completing this calculation, let us move ahead and take up a better question. Question number 2. A company has a book value per share of rupees 137.80. Its return on equity is 15% and follows a policy of retaining 60% of its annual earnings. If the opportunity cost of capital is 18%, what is the price of its share? Adopt the perpetual growth model to arrive at your solution. Let me remind you that Gordon's model otherwise is also known as perpetual growth model. So keep that into your notice. Perpetual growth model is just another name for Gordon's model. So friends, what is given to us? This is the book value of equity share, correct? Now this is basically the net worth of each equity share, or you can still call it book value per share. If return on equity is 15%, 15% of this would be the expected earnings of the company. If 60% of the earnings are being retained, it indirectly would mean 40% of the earnings are distributed by way of dividend. That means you can figure out what would be dividend, then return on equity given and retention ratio given. Through that you can figure out the growth rate, and this is the net worth per share, that is book value per share. Don't consider this as P0. P0 is what you have to find out, right? What is price of the share? So what all you will need for finding P0? P0 will be D1 upon KE minus G. So D1 will be 40% dividend out of the earnings. Earnings would be 15% of your net worth, and over here 18% is the opportunity cost of capital, that is KE. So let us see how to present the solution. Expected EPS by year end will be book value per share into return on equity, that would be rupees 20.67. Retention ratio is 60%, therefore dividend payout ratio would be 40%. Expected dividend by year end would be rupees 20.67. This is nothing but the expected earnings, and dividend payout ratio is 40%. 40% of that earnings would give you the expected dividend by year end. And one more thing that you should now work out is growth rate, which is return on equity multiplied by retention ratio. So it is 15 into 60%, that would be 9%. So friends, once you work out this much, you have enough information to calculate P0. But before we calculate P0, quickly write up this much, what you find on screen. Alright friends, let us move ahead and now use this information to determine the value of P0. P0 is D1 upon KE minus G. Define all the variables. D1 stands for expected dividend receivable by year end. We have obtained that value as 8.268. KE is the equity capitalization rate, 18%. P0 is the current market price of equity share that we have yet to find out, and G stands for growth rate, which we have determined as 9%. So let us put up these values in P0 formula, that is the Gordon's formula. P0 will be 8.268 divided by 0.18 minus 0.09. P0 will be finally 91.867. So note down this whole thing, and that will be end of the solution. Alright friends, you would have finished writing this much. Let us move ahead and start with question number 3. What is given over here? Given the following information, current dividend rupees 5, discount rate is 10%, growth rate is 2%. Calculate the present value of the stock. And the second part of the question says, is the stock overvalued if the price is rupees 40? Where ROE, that is return on equity, is given as 8% and EPS is rupees 3. Show your calculation as per PE multiple approach and earnings growth model. So friends, what we do is we first find out the present value of the stock, that is from the base information given in the question, which is going to be very simple. So P0 will be D1 upon KE minus G. You would obviously define the variables. Important thing over here is expected dividend receivable by year end. We have added 2% to rupees 5. Why? Because rupees 5 was not the expected dividend, it was the current dividend reported to you. So this point onward, take precaution whenever you have to work out the dividend which is expected. If the question informs you expected dividend, take it as it is. If it does not inform you expected dividend but provides you information about the current dividend, you add growth rate to that to arrive at the expected dividend. Then KE is equity capitalization rate, which is given as 10%, and P0 is what we have to find out, where growth rate is given as 2%. So P0 will be 5.10 divided by 0.1 minus 0.02, and that would be rupees 63.75. So do one thing, write up this much, and that will be the answer for the first part of the question. Alright friends, after writing up the answer for the first part, let us move ahead and use PE multiple approach for answering the second part. In the second part, they have asked you to use two approaches, PE multiple approach and the earnings growth model. So earnings per share is given as rupees 3. Price earning ratio is inverse of return on equity. So price earning ratio will be 1 divided by 0.08 because return on equity is given as 8% and price earning ratio would be inverse of return on equity. So price earning ratio would be 12.5 times and expected market price per share as per PE multiple would be EPS into price earning ratio, that is 3 into 12.5 and that would be rupees 37.5. Actual market price per share is given as rupees 40. So actual market price is greater than the expected market price. That means we can conclude that the stock is overpriced. Friends, I would explain you something very important out of this. But first you do one thing, you write up whatever you find on screen quickly. Alright friends, you would have finished writing this much, but let us not move ahead. Let me discuss something very important over here. We have concluded in one line that price earning ratio will be inverse of return on equity. Now, why it is like that? This line, you should be conceptually clear why price earning ratio is inverse of return on equity. The second part of the question informed that the return on equity is 8%. If return on equity is 8%, what does that mean? Suppose you have put 100 rupees as invested value for the price of the share today. You can expect an earnings of rupees 8 because return on equity is given as 8%. So by investing 100 rupees, you can expect income of or earnings of rupees 8. That is the significance of that return on equity. In other words, company has a potential of generating 8% on its equity. So just imagine if company has potential of generating 8% return on its equity, that means if the value of equity is 100, the earnings would be 8. I repeat, if the value of equity is 100, the earnings would be 8. Now just relate 100 and 8, these two values, and look into the value of the share would be how many times the earnings. Obviously, it will be 100 divided by 8 and that would be 12.5. That means price earning ratio, the ratio of market price per share by earnings per share would be 12.5 times. That 12.5 times you can directly figure out by taking inverse of 8%. So pick your calculator. 1 divided by 0.08 will directly give you 12.5 times. So this point onward, fit this concept into your mind that price earning ratio would be inverse of return on equity. Alternatively, if you want to figure out what is return on equity, you can take the inverse of price earning ratio. Friends, I have been telling you earlier as well, in this chapter, in corporate valuation chapter and in mergers and acquisitions, these three chapters, these common concepts would play substantial role. So don't ever mess with that. Keep in mind one thing, return on equity is the inverse of price earning ratio and vice versa, that is price earning ratio is inverse of return on equity. I am sure you have finished writing all this. Let us move ahead and deal with the second part of the question, where the base of valuation will not be PE multiple, it will be earnings growth model. So now let us apply the earnings growth model. So P0 will be E1 upon KE minus G. So in dividend based valuation, we take P0 equals to D1 upon KE minus G. In earnings growth model, we would take E1 upon KE minus G. Let us define the variables. E1 would be expected earnings per share by year end. Notice one thing, rupees 3 was informed as the current EPS, correct? So growth rate being 2%, the expected EPS for the next year would be 3.06. Equity capitalization rate in the second part has been taken as 8%, and P0 is what you have to find out. Growth rate given in the question is 2%. P0 is 3.06 divided by 0.08 minus 0.02, and that comes to rupees 51. Now friends, one very important thing, many students ask me a doubt that sir, 8% was reported as return on equity. Why did we assume this as equity capitalization rate? In fact, in the base information given in the question, 10% was given as discounting rate, correct? So why don't we apply 10% over here as KE? Why did we use 8%? Now friends, I would say taking over here 10% is definitely justified. The solution that I have given over here is exactly as per the ICAI study material and ICAI practice manual. However, if you are of the opinion that you should take 10% over here, obviously the answer will be different, but that will be still considered correct, because here what ICAI has done, whatever was return on equity, they have taken that as implied value for equity capitalization rate, whereas somebody could have taken equity capitalization rate as the discount rate informed in the question, which we have taken as KE in the first part of the solution. So friends, taking this as a 0.08 is just for maintaining the parity with ICAI solution. Otherwise you could put over here 10% also. In exam, if you write 10%, you will not be given wrong for what you have done. So do one thing, write up this whole thing and then we conclude further. Alright friends, you would have finished writing this much. After writing this, don't forget that the question has basically asked you to find out whether the share is underpriced or overpriced. Actual market price is quoted as rupees 40, which is less than the expected market price what we have arrived at P0 value as 51. That is more, and the actual market price is less, that was rupees 40. So we can say that the stock is underpriced. So friends, do one thing, write up this last concluding line, and that will be end of the solution. Alright friends, you would have finished writing this. Let us move ahead and take up question number 7. Now in this question, look what is given. Mr. A is contemplating purchase of 1000 equity shares of a company. His expectation of return is 10% before tax by way of dividend with an annual growth of 5%. The company's last dividend was rupees 2 per share. Even as he is contemplating, Mr. A suddenly finds, due to a budget announcement, dividend have been exempted from tax in the hands of the recipients, but the imposition of dividend distribution tax on the company is likely to lead to a fall in dividend of 20 paise per share. A's marginal tax rate is 30%. Required, calculate what should be Mr. A's estimates of the price per share before and after budget announcement. So friends, what we would do over here is, we will first determine the easier part of the calculation, that is expected price of the share before the budget announcement. Let us do that, and then we talk about the impact of budget. So let us first put up the easier part. Before budget announcement, simply P0 will be D1 upon KE minus G, and define the variables. D1 is expected dividend receivable by year end. Current dividend was rupees 2, growth rate is 5%, it will be 2.10. Equity capitalization rate or the expected rate of return would be 10%. P0, the current market price of equity share, is what you have to find out. G stands for growth rate, that is 5%. Put up these values. 2.10 divided by 0.1 minus 0.05 would give you P0 as rupees 42. This is the scenario, the simple scenario before budget announcement. Do one thing, write up this whole thing, and then we move ahead. Alright friends, you would have finished writing this whole thing. Let us now talk about the later part of the question where the budget announcement occurs. That means what would happen after the budget has been announced. So this scenario, what you find, was the mindset of the investor, was the mindset of the shareholder before the budget was announced. So what would be the impact of budget announcement? Let us first understand that. So the expected rate of return that we have considered over here, that is 10%, which is before tax rate of return. Now if tax rate is 30% and whatever the shareholder is earning before tax, that expected rate of return is 10%. In simple words, if I am an investor, if I am investing rupees 100, I would expect a return of 10%, that is rupees 10. But that rupees 10 what I am expecting to earn is before tax. On that 10 rupees of income, I have to pay tax of 30%. That would be rupees 3. So my post-tax net income is going to be 7%. Now, if my post-tax return is going to be 7%, I'm sure you understood why I am calling post-tax return as 7%. I would repeat if you want. If I am an investor investing rupees 100 and expecting to earn 10% before tax, what would happen? Out of rupees 100 invested, my expectation is to receive rupees 10 before tax. That 10 being my income, I have to pay 30% tax on my income. That would be 30% of rupees 10, that is rupees 3. If I pay off 3 as tax, what remains in my hand as the post-tax income is just rupees 7 by investing rupees 100. That means my post-tax rate of return is 7%. Now what will happen? The budget has declared that the dividend which will be received from the company will be exempted from tax. That means there will be no taxation on that dividend. As a result, the dividend will now not be capitalized at 10%. The dividend will now be capitalized at 7%. Why? Because now this dividend is as good as a post-tax income, because now that is not going to be subject to tax. So simple point is, if the dividend was taxable, you have capitalized the dividend with the pre-tax rate of 10% because the amount of dividend was before tax. Here, after the budget announcement, when now onward when you receive dividend, it will be already tax paid kind of dividend. Why? Because now the company will pay dividend distribution tax. So tax is already paid on that. It is not a pre-tax income, it is a post-tax income. So your expected rate of return that you apply on that dividend henceforth will not be the pre-tax rate of 10%, but would be the post-tax rate of 7%. This was one impact of budget announcement. The second impact of budget announcement was the base dividend amount that was rupees 2. It will not remain rupees 2 because 20 paisa out of that will be paid off in the form of tax by the company. That is in the form of dividend distribution tax. Company will pay it off. As a result, because the shareholder is receiving now dividend after the tax has been paid out of that, that means after considering dividend distribution tax, the base value which was rupees 2 will now not remain rupees 2, it will be 2 minus 0.20, that is rupees 2 minus 20 paisa, that will be 1.80. The base dividend itself will change. That is the second impact of budget announcement. Taking both of these implications, then when we compute P0 after budget announcement, we get what we want. So let us see how to present the solution of that second part. Let us first write up the impact of exempting the dividends in the hands of shareholder. In other words, we are talking about impact of budget announcement. Expected rate of return before tax was 10%. Marginal tax rate for the investor is 30%. Therefore, post-tax expected rate of return will be 10% into 1 minus tax rate, that will be 10% into 0.7, and that will be 7%. If the dividends are not taxable in the hands of shareholder, it is obvious that the expected rate of return will be same as the post-tax expected rate of return, that is 7%. Therefore, after budget announcement, revised KE will be taken as 7%. This explanation you will have to write as part of your answer. So come on, finish writing this part and then we move ahead. Alright friends, you would have finished writing this much. Let us move ahead and write up the second effect of budget announcement. Out of rupees 2 of the base dividend value, 20 paisa will be now removed by way of dividend distribution tax. That is the amount that company will pay as dividend tax out of the gross amount of dividend in hand. So the net amount of dividend base now gets reduced to 1.80. So expected dividend by year end after considering the 5% growth rate will be 1.80 plus 5%, that is 1.89. Write up this as well and then we move ahead. Alright friends, after we have written the implication of the budget announcement and calculated some small required values, let us move ahead and show the calculation of P0, that is the present value of the share after budget announcement. We will define the variables now little differently. I mean, the definition remains same, the value will change. D1 now will be 1.89, KE will be 7%, P0 is what you have to find, and growth rate remains 5%. So P0 would be 1.89 divided by 0.07 minus 0.05. P0 will be rupees 94.50. So write up this also, and that would be end of the solution. Alright friends, you would have finished writing this much. Let us move ahead and take up one more question, that is question number 9. It is given that in December 2011, AB company's share was sold for rupees 146 per share. A long-term earnings growth rate of 7.5% is anticipated. AB company is expected to pay dividend of rupees 3.36 per share. What rate of return an investor can expect to earn, assuming that dividends are expected to grow along with earnings at 7.5 per year in perpetuity? It is expected that AB company will earn about 10% on book equity and shall retain 60% of earnings. In this case, whether there would be any change in the growth rate and cost of equity. So friends, the first part of the question is very straightforward and simple. So let us figure out the answer for the first part first, and then we will think of how to answer the second part. So in the first part, you just have to find the expected rate of return or cost of equity, and that would be D1 by P0 plus G, where D1 is the expected dividend receivable by year end, that is 3.36. KE is the equity capitalization rate that we have to find out. P0 is the current market price of equity share that is already informed as 146, and G is growth rate, that is 7.5%. So we can see every tiny piece of information is straight away available in the first part, and we can easily put up the solution. We will get the resulting KE as a 9.8%. So quickly write up all these calculations and then we move ahead. Now let us once again focus on the question and read the second part. So if you again look into the first part, was straight and simple, right? Expected dividend was given, the growth rate was given, and current share price was also given. Any way you can easily work out the rate of return that the investor can expect. Done. Second part now says the company will earn about 10% on book equity and shall retain 60% of earnings. That means whatever earnings the company has, 60% of that will be retained. In other words, dividend payout ratio would be 40%. Now, what will happen is you have to now accommodate this information for determining the revised growth rate and the cost of equity. So let us see how to present the answer for this second part. Now in the second part of the solution, we would say growth rate is retention ratio multiplied to return on equity. The return on equity is given as 10% and retention ratio is 60%. So obviously growth rate would be 6% without doubts. Earlier growth rate was 7.5%. So earlier retention ratio must be 75% because ROE being 10%. Therefore, earlier dividend payout ratio must be 1 minus 75%, that is 25%. With the expected dividend of rupees 3.36 and dividend payout ratio of 25%, earlier the EPS must have been rupees 13.44. And now the new payout ratio is 1 minus 60%. Why? Because the new retention ratio is given as 60%. So the new payout ratio has to be 40%. But your EPS would still remain same, correct? That was 13.44. So expected dividend now by end of the year would be 40% of your earnings, that is rupees 5.376. So friends, do one thing, write up this much and then we move ahead. Alright friends, after writing up all these base calculations, let us move ahead and determine the revised KE. Revised growth rate we have already figured out. Revised KE. Now D1 has changed to rupees 5.376. P0 remains 146 and growth rate has got changed to 6%. Impact of that would be the revised KE comes as 9.68%. So note down this as well, and that will be end of the solution. Alright friends, you would have finished writing this whole thing. Now let us summarize what we have discussed in this session. We started with share valuation and we have learned the very simple basic fundamentals of share valuation, and then we have focused mainly in this session on dividend based valuation, and particularly the major focus was on Gordon's model. Now in the next class, we are going to cover up the Gordon's model with the scenario of variability in the growth rate. That means where growth rate does not remain constant, when there is a variation in the growth rate, how would you then apply Gordon's model? That is something required to be learned in the next class. But this class, let us put an end to this and let us declare this as end of part 1. So friends, revise everything very well and practice out all the similar type of questions given to you, and I would say thank you so much for attending this class.